Hello everybody and welcome. In this video, what we're going to go over is how to calculate capital gains tax in Canada for 2026. So for the first part of the video, what I like to go over with you is common misconceptions surrounding capital gains tax. And then after that, we're going to go into a little bit detail to actually calculate the taxes. Now, with all that being said, let's just jump right into the video. So misconception number one that I would like to discuss with you is the 50% rule. So the 50% rule, the common misconception here is that this is the tax rate. So for example, if you made a profit of $10,000 in a given year, you're not paying $5,000 taxes to the government. That's not the way it works. Instead, 50% represents the inclusion rate. So out of the $10,000 that you made in profit, only $5,000 will be included as your income at the end of the year when you're filing your taxes. Now, how to calculate the taxes on that $5,000, we're going to go over that a little bit later on in the video. The second misconception that I like to discuss, there's two parts to this. Part one is the 67% rule. So the 67% rule is just like the 50% rule. This is an inclusion rate. It is not a tax rate. Part two of this misconception, 67% is not the inclusion rate on the entire amount. It is just the inclusion rate on everything above $250,000. So for example, if you made a profit of $300,000 in a given year, the first $250,000 would have an inclusion rate of 50% or $125,000. And then the remaining $50,000 would have an inclusion rate of 67% or $33,000 for a grand total of roughly $158,000. Now, again, just with the first example, I will show you in detail how to calculate the actual tax that you will have to pay on this $300,000 capital gains in just a moment. But before I do that, there's one thing that I'd like to talk about to you first. Hi everybody, today's sponsor of the video is me. I would like to tell you that if you are an investor and you like to keep track of your investments as well as your capital gains, the best way of doing that is probably in Microsoft Excel. Now, I understand that some of you might not be familiar with Microsoft Excel. And if you are not familiar with Microsoft Excel, the good news is that I have an online course in which you can learn at your own pace because I have over 100 different lecture videos individually bookmarked. So for example, if you would like to learn about VLOOKUP, I have a couple of videos on VLOOKUP. If it's pivot tables that you're after, I have an entire chapter on pivot tables. So if you'd like to accelerate your knowledge and go from beginner to pro in Microsoft Excel, my course is the course for you. And the link is in the comments section below. Now let's get back into the video. Welcome back, guys. So the two examples that we looked at earlier, now let's get into the weeds a little bit to see how you would actually calculate the taxes, right? So on the first example with a $10,000 profit, we already know that the inclusion rate is at 50%. So that means $5,000 would be added to your income at the end of the year for tax purposes. So let's say, for example, the average salary in Canada is $65,000 a year. So let's say that's what you earned in this given year, plus you made the $10,000 in capital gains, right? So that would put you in the tax bracket where you would need to pay roughly 30% on the $5,000 that we are including from the capital gains. And then this would result in you paying taxes just under $1,500. So that's $1,500. That's still not something that you would like to do, but these are the rules we have to abide by, but still way better than paying the $5,000 that some of you might have thought that you would have had to pay. Now, in the second example, we have $300,000 of profits. The first $250,000 we included on our income at an inclusion rate of 50% or $125,000, and the remaining $50,000 at 67% or $33,000 for a grand total of $158,000. Now, if we make the average salary in Canada, which is $65,000, plus you're adding the 300,000 capital gains, that would mean that you're going to roughly pay around 42% on the $158,000, which is roughly $68,000 that you're going to have to pay in taxes, right? So again, that's pretty rough. You're paying $68,000. However, it's much better than the $150,000 or the $167,000 that some of you might have thought that you would have to pay. So in example number one, your effective tax rate would be just under 15%. And in this second example, your effective tax rate would be right around 22%. So that brings us to the end of the video, guys. What did you think? Was this helpful for you? If it was, I would love to hear the comments in the section below. Also, if you enjoyed the video today, if you learned something, give me a like, a subscribe. I would really appreciate that. I hope you enjoyed the video. I hope you learned something. And as always, keep fit and have fun.